Hey everyone, happy Thursday, May 16th. It's about 9:50 in the morning on the West Coast, and it's time for another market update. Going back to last week, mortgage rates been a nice little rally, dropped about a quarter of a point from the week prior, and I'm happy to report that continued this week with some favorable inflation data and some other stuff we'll take a look at. So first, a couple days ago, we got the April CPI inflation report. This one was not friendly to us in March. Keep in mind that the Fed's favorite report to look at is the PCE inflation report, but this one gives us an idea, a heads up of what might come on that PCE report later this month, and it came in, pretty helpful. It came month over month was up about 0.3%. Estimate was 0.4. Core came in as estimated, up 0.3%. Taking a closer look. As you can see, they kind of round up and round down. So the headline was at 0.3, cores was 0.3. But as you can see, the real numbers a little higher, a little lower. But the main thing we want to look at here is this core. It's at 3.62 year over year. And as you can see, 45.4% of the core is made up of shelter, which is rents, owner's equivalent rent, lodging away. And those they're coming down a little bit, but still, making up a big portion of this core inflation rate. So, shelter at 0.4, that's coming down, but 0.4 times 12 would be almost 5%. And that's not a good number year over year. And as you can see, the yearly effect out of this 3.62%, shelter is making up 2.51% of that 3.62. So shelter is a huge part of that. The other huge part of that this year has been motor vehicle insurance. Motor vehicle insurance only takes up 3.7% of the core, but right now it's accounting for, 0.84% of that year over year number. And again, they include this as part of core, the core number, but motor vehicle insurance is going up because of the cost to do repairs, more break-ins, things like that, which are not, that's not something that the Fed can affect with their Fed rate. So it's a little interesting they have it in core. And then everything else core is almost, less about a quarter of a point. So 0.27. So you add those all up, that's where you get that 3.62. So all shelter and motor vehicle insurance. So motor vehicle insurance, I don't know if that's going to come down anytime soon. I'm sure we've all kind of got our increases. And then shelter, that's where we need things to help out a little bit and to get that core number down a little bit lower. But overall, not too bad. Next one, we got the day before that, we got April PPI. And this came in higher than expected. It went up 0.5%, which I believe the headline was supposed to go up 0.4. The core was supposed to go up 0.2, and it went up 0.5%. So at first the markets freaked out, but really what it was is they made big negative revisions to March. March, originally both numbers came out plus 0.2. Instead, they negatively revised both those down by 0.3%. So now those March numbers were both negative numbers, both negative 0.1. So that's why this plus 0.5. So, it's going off the previous month. So, the previous month ended up being a negative, and that's why April came up a little hotter. So, at first the markets didn't like that. After a little closer look, they kind of digested that and things came back a little bit. So as you can see, producer price index inflation is way down for where it was at its peak a couple years ago, ticking back up a little bit. So we got to keep an eye on that. But overall, this was another, inflation report that was pretty friendly for us this week after, the markets figured it out. And then also what we got the same time as CPI was April retail sales. And this came in flat month over month. I think it was supposed to be up 0.3%. The core was actually down, negative 0.3%. So that was another sign, with all these other metrics, credit card usage, savings rate down for people. But it looks like American consumers are spending less money. That's not good for the job market, but it is good for inflation. And that is something that the markets reacted pretty positively to. And the other thing about these retail sales, these will get plugged into this core number, will get plugged into the GDP for the United States. And so that's probably going to come in lower because of this, which again shows the economy slowing down, can maybe tell the Fed, hey, you guys got to cut rates to stimulate the economy. And that's what, ultimately what we want. And then also today we got housing starts and permits. There was a slowdown in permits, so I'll take a closer look at this. So this was for April. Permits down month over month 3%, year over year down 2%. Keep in mind these numbers are including both single family and multifamily. Starts were up month over month, but down year over year. Completions are up, 8.6% month over month and 14.6% over year. A bunch of multifamily coming online. So that should help with rental prices. But in the long run, this permits number, keep in mind, this is our future demand. Future supply. So with this going down, where we need to go up right now, future demand, household formations is running about 1.8, 1.9 million per year. So 1.44, we're basically, operating at deficits. So, this is good. These completions is going to be good for rental prices in the short term, but long term, the less housing there is, the more expensive housing is going to be. So that's a good thing for current homeowners. That's good for appreciation. Next thing, we got initial jobless claims. Again, this is very, very important. Fed is paying very close attention to the unemployment stuff. Came in a little bit higher than expected, down from last week, which was a higher number comparatively where it's been. But at 222, this is, it looks like it's ticking up for where a long time there was about 210 for almost a year. So, these ticking up a little bit. The more that goes up, the better chance that unemployment rate is going to tick up to 4 or above. And like we've talked about, that's where we can start feeling a little more confident that the Fed will cut their rates. If unemployment stays low, that comes a little more in doubt. So where does that leave us? Average 30-year drop below 7% again. Again, we're making up ground that we lost over the last couple months, but it's nice, at least, to have that win that battle, get below 7 at 6.99. Might tick back above that, here next week. But, remember, we ticked above 7.5 2 weeks ago. So to get down to 6.99, that's a nice little rally in 2 weeks. If we could drop a fifth of a point or a quarter of a point every week, that would be great. We won't, but that would be great. So important dates coming up. We got PCE inflation, like I mentioned, coming up on May 31st. That's our next big report. That would be a market mover. Hopefully, some of that that PPI stuff, with inflation coming down a little bit on their end, hopefully that helps us in that PCE report. BLS jobs report comes up on June 7th. That's always a big one. That's, unemployment ticks up there. That's going to be really good for us. Not good for people that lost their jobs, but very good for rates. CPI, again, we'll get June 12th. And then that same day, we get the Fed's next meeting, June 12th. Well, right now, the markets are saying like a 9% chance of a cut then. But then at their July meeting, I believe it's, about 35%. So that's gone up a little bit. And then September, we're running about 75%. So, this week with the retail sales and inflation coming a little bit more what we want, with unemployment ticking up last BLS jobs report, things are heading in the right direction. Obviously, we like a little lower, but, it's good to see some progress. Keep in mind, though, once rates do drop, prices are probably going to go up because there's a lot of pent-up demand right now. So, if you can afford a house right now, if it makes sense for you to refi right now to pay off some credit card debt, stuff like that, that's, now no better time than now. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, and let's hope this rally continues. Bye, guys.